All right, let's talk about the earthquake that's hitting one of the market's most trusted sectors. For almost 2 decades, software was a golden ticket. It was an unshakable annuity, but the rules have just been completely rewritten, and what used to be a safe haven has now become Wall Street's most dangerous new trap.
$3 trillion. In less than 2 months, the software industry saw $3 trillion in value just evaporate. Now, to put that into perspective, that's like the entire annual GDP of the United Kingdom. Just gone. This wasn't some slow leak. This was a catastrophic failure, a fundamental repricing that has everyone scrambling.
And this gets right to the heart of the problem. We're not talking about a normal market correction or some temporary dip. The market has finally woken up to the fact that this AI revolution, well, it isn't here to help software companies sell more stuff. No, it's here to do the very jobs their software was built for, and that threatens their entire reason for being.
So that's the multi-trillion-dollar question we're going to break down today, isn't it? For years, buying software stocks on any sign of weakness was a guaranteed win. It was a no-brainer. But what if that whole game has permanently changed? We're going to dig into the data and figure out if this is a historic opportunity or a classic value trap just waiting to snap shut.
To really understand what's happening, we have to start with this big mystery that's got investors completely stumped in 2026. It's called the Great Decoupling. You see, tech isn't one big happy family anymore. We're witnessing a violent split, a divorce, really, between the companies that make the hardware powering AI and the companies that make the software that AI is about to replace.
And I mean, just look at these numbers. They tell the entire story. It is absolutely brutal. The semiconductor index, that's the chip guys, is up a staggering 133% in the last year, all thanks to a massive spending spree on AI infrastructure. And meanwhile, the software index, it's down 20%. But here's the kicker. Look at that trend strength. Not a single S&P 500 software stock is trading above its long-term average. Not one. This isn't a correction. It's a sector-wide collapse.
This whole situation just turns the old playbook completely upside down. For more than a decade, the strategy was so simple. Tech goes up and software leads the charge. Buying the dip became this conditioned reflex for a whole generation of investors. So what the heck happened? Why has that strategy suddenly stopped working and actually become dangerous?
Well, the answer lies in the very engine that powered the whole SaaS empire for 20 years. The business model that made software a Wall Street darling. That per-seat, per-month subscription is now the very source of its own destruction. AI is attacking the most fundamental unit of SaaS revenue.
The key idea to wrap your head around here is something called seat compression. Think about it like this. SaaS revenue was always simple. A company hires 100 new salespeople, they go out and buy 100 new Salesforce licenses. Easy. But what happens when one AI agent can do the work of 10 human reps? It can update records, draft emails, manage the pipeline, all on its own. While the company doesn't need 100 licenses anymore, they might only need 10. That is seat compression, and it is the silent killer of this entire business model.
And listen, this isn't some far-off futuristic theory. This is happening right now, across pretty much every category. For CRMs, AI agents are making sales rep licenses redundant. For project management tools, AI agents are tracking everything so people don't even need to log into the dashboard anymore. And customer support? Whoa. Multi-agent systems are now handling more than 80% of support tickets, absolutely decimating the need for human agent seats on platforms like Zendesk. You see, the old model was beautiful in its simplicity. More employees meant more revenue for SaaS companies. But AI completely inverts this whole equation. Now, AI makes companies way more productive with fewer employees, which means less revenue for SaaS. And here's the ultimate irony. Companies are literally cutting their software budgets so they can free up cash to pay for the AI infrastructure that is making their old software obsolete. It's a vicious cycle. Okay, so let's shift gears a little bit. This isn't just a story. It's a story being told by the numbers. Let's look at how this disruption is mathematically erasing the future value of these companies. This is where we move from the business model to the financial models that Wall Street actually uses to price these stocks. For years, the gold standard for judging a SaaS company's health was something called the Rule of 40. It was a simple, elegant little formula. Your revenue growth rate plus your profit margin should be more than 40%. It was all about balance. If you were growing like a weed, you could lose a little money. If you were growing slower, you had to be profitable. As long as you cleared that 40% hurdle, investors were happy. But take a look at the reality in 2026. The median, the typical public SaaS company, its score is just 28%. That's a failing grade. Growth is stalled so hard that even with better profits from layoffs, the math just doesn't work. And even for a giant like Salesforce that's technically passing, look closer at the numbers. Almost all of its score is coming from profit margin. Its growth is down to single digits. That's a huge red flag. It signals a shift from a growth asset to a legacy utility, and the market is repricing it for that new reality.
So analysts are now looking at software through these three different lenses of risk, and it's collapsing what they call the terminal value in their financial models. Now, terminal value is just a fancy way of saying all of a company's future profits forever. For SaaS, this number used to be gigantic because everyone assumed they'd grow forever. But now, analysts see a finite life asset with a ticking clock on it. The risk that AI will just wipe out an entire category means those juicy long-term growth assumptions, they've just been erased.
This new reality has created a really dangerous situation in the market. You've got this massive split between what the big institutional funds are doing and how everyday investors are reacting to these falling stock prices.
And the contrast between the two strategies is it's stark. The institutional playbook is clear. Sell software and buy the AI infrastructure that's replacing it. They're even shorting the sector, betting it will go down further. But the retail playbook seems to be stuck in the past. We just saw one of the strongest months for retail buying of software since the 2021 peak. They're buying the dip, using a strategy that worked for 15 years but is failing catastrophically today.
And this right here is the brutal, honest truth of a value trap. A stock looks cheap based on where it used to be, but it's actually priced for a future that is being systematically dismantled. Retail investors, drawn to the familiar, trusted names they know, are essentially just holding the door open for the big funds to get out. They are buying exactly what the smart money is desperately trying to sell.
So, if the old model is completely broken, how in the world does any software company survive this mess? And more importantly, for all of us as investors, what are the signs of a company that might actually make it through to the other side? Because believe me, there are new rules for this new world.
The market is drawing a really clear line in the sand. On one side, you have what you can call workflow wrappers. These are tools that are basically just a pretty user interface on top of a sequence of steps. They're incredibly vulnerable because a single AI agent can just replicate their entire function. But on the other side, you have the systems of record. These are the platforms that hold the irreplaceable proprietary data, the crown jewels, like your core financial ledger or your engineering designs. These platforms actually become more valuable in an AI world because they become the essential data layer that AI agents need to read from and write to.
So, for any SaaS company to survive this, they need to execute on these four things. And they need to do it right now. First, they have to get into the AI budget, not the shrinking software budget. Second, they have to completely abandon the dying per-seat pricing model. Third, they must own a defensible data moat that AI can't just replicate. And fourth, and this one is critical, they have to redesign their entire platform so it can be operated by AIs, not just by humans. The era of easy growth is definitively, completely over.
So ultimately, this forces every single one of us to ask a really hard question. The massive discounts we're seeing in software stocks today, they aren't a bargain. The market isn't stupid. It's correctly pricing in the fundamental decline of an entire asset class. The software as a service model that dominated tech for 2 decades is being replaced right before our eyes, and we have to reconsider what value truly means in the age of AI.